Are you a beginner in the world of investing, eager to grasp the basics and discover some tips and tricks to kickstart your journey to financial success? Well, you're in the right place. In this video, we'll provide you with a beginner's guide to investing in stocks. So, whether you're new to the game or looking to sharpen your investment skills, stay tuned because we've got you covered. What are stocks? Stocks, often called shares or equities, are your ticket to owning a piece of a company. Imagine a company as a big pie, and each stock you buy is like a slice of that pie. When you own stocks, you get some special rights and rewards. Ownership share. Owning a stock means you're a shareholder or stockholder of the company. Think of it as having a say in certain company decisions, especially if you have a lot of shares. For instance, it's like being part of a club where you get to vote on things like picking the company's leaders or agreeing to big changes. Example, imagine you own lots of shares in a toy company. The company wants to make a new kind of toy, and they ask all the shareholders, including you, to vote on it. Your vote matters because you're a shareholder with a piece of the company. Dividends. Some companies share their profits with shareholders by paying dividends. This is like getting a bonus. These bonuses usually come in regularly, like every 3 months or once a year. So, owning stocks can give you a little extra money on the side. Example, suppose you own shares in a famous ice cream company. Because they're doing really well, they decide to share some of their profits with you and other shareholders. You get a nice check just for owning their stock. Capital appreciation. When a company does great and is expected to do even better, the price of its stock can go up. That's good news for you because it means you could sell your shares for more than you paid, making a profit. Example, let's say you bought shares in a tech company when they were $50 each. Over time, the company invents something amazing and the stock price soars to $100 per share. If you decide to sell then, you'll make $50 for each share you own. Risk and reward. Stocks can be a bit like a roller coaster. They can bring both excitement and challenges. Historically, they've offered nice rewards if you hang in there for the long run. But keep in mind, they can also drop in value due to various reasons like economic changes, how well the company is doing, or how people feel about the stock market. So, there's a chance you could gain or lose money. Now that we got the basics down, here's a step-by-step guide how to start investing in stocks. Select a brokerage account. Think of this as opening a special online bank account for buying and selling stocks. Look for one that suits your needs, offers research tools, and provides support. Fund your account. This step involves transferring money from your regular bank account to your new brokerage account. This money is what you'll use to buy stocks. Research and selection. Before you start shopping for stocks, do your homework. Check out different companies, their financial health, future potential, competition, and industry trends. You're aiming to pick stocks that match your goals and comfort with risk. Example, suppose you're interested in electric car companies. You research Tesla, which has been making waves. You see they have a good financial outlook, lots of customers, and plans for growth. So, you decide to consider buying their stock. Purchase stocks. With your brokerage account, you can place orders to buy the stocks you've chosen. You specify how many shares you want and the price you're willing to pay. Example, you use your brokerage account to buy 10 shares of Tesla at $500 each. This means you're spending $5,000 to become a Tesla shareholder. Monitor your portfolio. Once you own stocks, keep an eye on them. Check how they're doing regularly and stay updated on news that might affect your investments. Diversification. To be a smart investor, spread your investments around. Don't put all your eggs in one basket. Think of it like having a variety of different snacks in your pantry instead of just one. Example, instead of only owning Tesla stock, you also buy shares in a healthcare company and a tech giant. If one doesn't do well, the others might balance things out. Now, let's explore different ways people handle their stocks. Investment styles. Buy and hold. Some investors buy stocks and keep them for a very long time, even decades. It's similar to planting a seed and waiting for it to grow into a big, strong tree without fussing over it constantly. Traders. They aim to make money by quickly buying and selling stocks based on short-term price changes. But this style requires careful watching and a deep understanding of market trends. Speculators. Think of speculators as adventure seekers. They focus on smaller, riskier stocks with the potential for a big price swings. While they might strike gold, there is also a higher chance of losing. So, they're cautious not to bet everything on a single risky venture. Dividend investors. These folks love getting regular paychecks from their investments. They prioritize stocks that offer consistent dividends, which can be like picking fruit from a money tree. Many reinvest these dividends to grow their wealth over time. Before we dive deeper, if you find this video helpful, hit that like button and subscribe to our channel. Done? Now let's continue. As a beginner in the stock market, you may wonder which stocks to consider. With a vast array of options available, let's narrow down your choices. Selecting stocks for beginners. Focus on stability. It's usually a good idea for beginners to start with well-established companies. These big companies have a strong track record and don't usually jump up and down in price as much. It's like putting your money in a sturdy oak tree instead of a younger, wobbly sapling. Risk management. Remember that the stock market isn't a guaranteed shortcut to riches. Beginners should consider starting with a smaller amount of money and avoid rushing into high-risk stocks without gaining experience. Slow and steady often works better than quick decisions. Diversification. To further lower risk, consider spreading your investments across different types of stocks and industries. It's like not putting all your money on a single horse in a race. Index funds. If you'd rather take it easy, index funds are a great choice. These funds include lots of different stocks, giving you diversity without the hassle of picking individual stocks. Think of it as a buffet of stocks where you can try a little bit of everything. Again, and I cannot emphasize this enough, do your research. Investigate the business. Learn what the company does, how it makes money, and who its competition is. If you're thinking about investing in a smartphone company, find out what makes their phones special and why people might choose them over other brands. Analyze competitive position. Figure out how the company stacks up against its rivals. Do they have something unique or better that keeps customers coming back? Imagine the smartphone company has a patented feature that no one else has. That could give them an edge. Future prospects. Consider where the company might be headed. Why do you think it has a bright future? Are there any threats or challenges it might face? Example, you see that the smartphone company is expanding into new markets, which could mean more sales and growth in the future. Valuation. Think about the price of the stock. Is it too expensive, too cheap, or just right? Compare it to how the company is performing and what other similar companies are worth. Example, you notice that the smartphone company's stock price seems low compared to similar companies. This could be a sign that it's a good deal. In summary, investing in stocks can be exciting and rewarding, but it's essential to match your investment style with your goals and comfort with risk. Whether you choose to buy and hold, trade, speculate, or focus on dividends, remember that there's no one-size-fits-all approach. The key is understanding the pros and cons of each method and making informed decisions. As a beginner, consider starting with well-established companies. Manage risk through diversification and don't rush into high-risk investments. Always do your research and approach stock investing as if you're buying a real business. With patience and knowledge, the stock market can be a valuable tool for building your financial future. Congratulations! You've just taken your first step into the exciting world of stocks. Now, here's a fun question for you. Which investment style suits you best? Are you the patient type, a quick trader, a daring risk taker, or all about those dividends? Share your choice in the comments. And hey, if you enjoyed today's journey into the world of stocks, remember to hit that like button and subscribe for more financial insights. Your adventure in investing starts here.